and I'm sure your wealth advisor have told you this. If you compound money at 25% over a 30-year period, you would have made 100 times for your starting capital. So compounding has this dramatic effect of being able to create a lot of value at the end of it all.
So P as per in relation to the Sensex or P in relation to the individual companies?
No, so P in relation to the Sensex, at
Okay.
an overall level, because each individual company will have different Ps depending on their ROEs. So it's a very, very different number.
So do you go out into the colleges to tell the young people about this, or you all don't?
No, we do, but not enough if you ask me. I think we need to do a lot more. We have to find a more efficient way because, you don't touch as many people as you would like to. But yeah, we do have programs. We've launched, in fact, we have a women investors program, by the way. Anybody here who's interested, please visit our office. We have a special education initiative for women investors where we have a lot of explanation of how investing works, etc. And we go out to, we run special camps in a lot of the IT companies because that's where you have a lot of young kids who have just started earning, and you want to train those people. The problem with college kids is they haven't started earning yet. So they'll listen to you and then, then it wears off. 1 week later, they've forgotten what you said. But when you're earning, it's easier to touch base with them and then to create a response.
Good evening, sir. Just wanted to have an insight on, sir, what is your investment process? As in, what are the criteria for the selection of stocks and valuation?
Sure.
So on those lines, can you just throw some light?
Sure.
And, sir, you said your portfolio comprises of mix of cyclicals and
Defensives.
maybe some bull market stocks and stuff and all. So, but don't you think, sir, if your process is good enough, then you should stick to some. You should have a concentrated portfolio to some extent.
Yeah.
And so one more aspect.
Sure.
Could you share some of your key mistakes through your career?
That'll take the whole day.
Maybe a couple of interesting ones where which can.
Yeah, sure. Okay, so good questions in terms of portfolios. Now, so what we do is, like Gajendra mentioned, we have multiple portfolios that we manage. And typically, the way the industry is structured is that we can't just look at all of these portfolios in isolation. They all work to a benchmark. There's a benchmark index that you have to work against. So that benchmark could be the Nifty, it could be the CNX 500, it could be the BSE 100. There's a benchmark that the regulator forces you. You have no choice. When you file a new fund, you always have to have a benchmark mentioned. And then what you have to do is that benchmark determines the nature of stocks in your portfolio. So you have to invest in the sort of companies that are in your benchmark. That drives the portfolios. So if we have a large cap fund, it has a large cap benchmark. We have a mid cap fund, it has a mid cap benchmark. And there'll be different stocks, obviously. They can't be the same stocks in those two funds. So because of that, and because of the fact that we run what we call open-ended funds, where people can walk in and walk out at any time, we have to also make sure there is some degree of liquidity in the portfolio. So that's where your portfolio, you create a more diversified portfolio so that you have enough of companies, you have liquidity in case the situation demands. You can, it's not very easy, I'll tell you, when you're running, let's say a 5,000 crore portfolio, to own just 10 names of 500 crores each. So by default, you end up, owning a slightly wider range so that you at least have the ability to maneuver your positions if you have to. Let's say something goes wrong in the company, you need to change your mind, you need to actually be able to sell it. So that sort of drives a lot of these portfolio construction issues and diversification, etc. And we always have a mix of, at this point in time, we're actually building a slightly higher mix of some cyclical stocks. Although that's not the trend, those are not performing, but we see more value in them. We see that their prices are cheap and we find it palatable. So we're hoping that there will be an economic recovery at some stage. ROEs will pick up and then the stock prices will do better for the same reasons that I explained to you. So that is sort of where we are at the moment. In terms of mistakes, our biggest mistakes have been reading of managements, if at all. I had to summarize it very briefly. When you look at a company, and again the question was asked, what do you look for in a company when you're looking into it, in your process? So very simply, the most enduring part of your investment, if you're going to invest in a company for a long period of time, the quality of management of that company becomes important, the most important element. So one is the business economics of that company, which anyone can figure out very quickly. For anyone here, and by the way, now everything is available on internet, you can just look at any company and see its 10-year ROE history on any of these websites. And the minute you look at the ROE, you'll know what type of business it is. If it's a steady ROE, it's a defensive business. If it's all over the place, it's a cyclical business. So one is you look at that, and then you look also at the management quality, because that is the most enduring effect on a company. And we've seen enough of these when a new management comes in. So this is something we track very closely. Any change in management, we need to go there and meet the new management right away, just to understand the psychology. We've seen some great companies getting totally killed by a management change, and we've seen some really lousy companies come back very strongly because of a good management change. So I'll give you an example. IndusInd Bank, which was very poorly managed. It had, not very good or not very great perception on the promoters. It wasn't very well managed as well. And then they went and brought in Mr. Ramesh Sopti of ABN AMRO Bank. And, he's just brought in a whole bunch of people and turned that bank around and made it one of the biggest shareholder value creators in the last 5 years. So those are very important times in a company's life cycle when you have management changes. It's almost like what happens at a country level. And you'll be shocked at how much one leader can influence the entire culture of the company. So one little change at the top can have a dramatic effect. We're seeing this to some extent at a country level, and it definitely happens at a corporate level. So that is very important. So management, business economics, growth. Typically, you're trying to look for companies that are growing, not degrowing for whatever reason. And the scalability of the company. Is this business something that can grow over time? And therefore, along with that, can the company increase its market share? Is there a basic underlying rate of growth that will anyway push the company along? So these are the broad 4 factors that, if you just have 4 ticks against them, I think the chances of success are very high. And you don't have to really complicate it beyond that. People get into this ratio, this detail, that just doesn't matter. You just get this right and you'll more than often do well.
Anup, you answered 50% of my question. That was quality of management. What about integrity of the management? Because I don't want to hold Satyam share or financial technology share and wake up in the morning saying that it is at 6 rupees.
Sure.
Right?
Yeah.
That's one question. And as you address 50% of it, I would also like to know how you take care of oil prices, because our economy is driven by oil. So how you take care of oil prices when you create the portfolio?
Okay. So integrity, I've sort of clubbed with quality. Quality was an overriding word I used, but it means all the ingredients on corporate governance.
You may feel that the management is a quality management, but on that side, what they are doing, you may not know.
No, that of course. So that we have to make sure we try and avoid that to the best of our ability. But sometimes, if there is something really devious going on right at the back, you may not even be able to know. And your assumption normally is, you'll have that bad luck 1 in 1,000 times, but not too often. But coming to your point on oil prices, now strangely enough, if you draw a correlation of oil prices to the stock market or oil prices to earnings growth, you will actually see no correlation. Oil prices are actually a very, very different cup of tea. So there is this tendency to think that in the near term, oil prices are making a big impact, and maybe they do in very short periods of time. But markets adjust to it very quickly, and over long periods of time, it doesn't matter at all. Oil used to be way back in 1997 when markets were actually not doing well, the economy was slow. oil was in single digits. Oil was $6-7 a barrel, and people were saying it's going to go down to $2. After that, we've seen $100 oil, and we've seen our markets at highs. We've seen earnings at an all-time high. And now we're seeing it at 50. And this is probably more, if you do a 200-year, oil is one commodity that has a 200-year history. You can draw a 200-year chart. And if you draw a 200-year chart on oil, you'll see oil is flat and it has, one or two spikes like this. The average is 40 to 50 only over a very, very long period of time. And once in a while, it'll go to 100 and come back. And that's very few and far between. And that's what's happened. And I think now it just stays down for a fairly long period. But oil actually is not a massive ingredient in your analysis of investing, surprisingly. It can matter in the short run, but not in the long run.
Next question. I think we were at the end.
I had a very
This is slightly off track. Since we are talking about long term, the pension schemes, very low awareness is there in India. How do you compare NTS to mutual funds?
Yeah. Well, I'm hoping that we have, pension money more and more open to investing into equities. The problem currently is the general perception of equities is it's something that is very volatile. It has a lot of risk, and therefore let's not even venture there. That's the general thought process that the government has had or these pension funds have had. Whereas worldwide, everybody, most places, particularly the US, are way beyond it. If you remember, in the big boom in the US started in 1980. There was a very strong bull market that started. And it started with the 401k pension plans that people have in the US. So over there, anybody who's employed has a pension plan where they have the right to invest into equity funds, debt funds, and they can choose what they want to do. So when they opened it up, the point is give investors the choice, right? Finally, it is in a way their money that you're managing. And they should have more leeway in terms of exposure to equities. So the government has now started this in a small way. They've given a leeway, but like everything in India, it becomes a controversy instantly. There are a long line of people who will say, we want to have a strike around this. This is not acceptable, blah, blah, blah. But, it's part of a democracy here. But the fact is, it's the most obvious thing on the planet that will add value over long term. You cannot beat inflation consistently through fixed income. You'll marginally beat it, but you don't really generate big wealth for yourself over time. So I think equities is, for long-term pension schemes, it shouldn't be a question at all. So I'm just hoping somewhere somebody sees the light of day or is enlightened enough to do that.
Mine is a pretty specific question. Now we are seeing that two different worlds are emerging right now. Okay. On one side we are having China, which is slowing down. We have Europe, which is contracting. We have Japan in complete recession. We have US, which is risking on the points of there may be a rate hike or something. So there we get this information that probably the equities is not the right place. On the other hand, you have India, which is showing a strong growth potential. So my question is basically, how do you place cyclicals right now when you see global commodity prices which are seriously slowing down and there's no lot of hope seen there, and you have cyclicals in India like the steel, cement. So how do you play the cyclicals right now, and what could be the multi-baggers given the management information that you have?
He threw in a googly right at the end. So
from an investor.
Yeah. No, so I'll tell you.
Anup, I hope we have investors like this more and more in India,
So one is, as far as the whole world is concerned, listen, much as I would love to come here and pontificate on my views on China and the world, it doesn't really matter, because we can discuss it till the cows come home, but the fact is something else will end up happening. Nobody can predict these events. They are working countervailing forces. It makes for great newspaper reading. It makes for great evening conversation, but it adds no value to your investment style. So I would not spend 1 minute, frankly, of my mind. Not that I don't, I have to, because our job unfortunately requires us to. But you have the liberty of ignoring it. And I would say you would be best served ignoring it. because everybody is a hindsight expert. We're all very good at explaining what happened, but very few people can, nobody can really predict what exactly is going to happen. So this is all noise. And honestly, if you had that rather opposite psychology that I talked about, you would be almost hoping something bad happens. So it gives you a chance to get it, right? So at a personal level, however horrid it may sound, I would be very, very happy if we have a global crisis again and we get markets down 50% and you get another chance to invest, because it will all come back. I can assure you in a certain time frame, we'll be back to a new high again. So when we are looking at cyclicals, we're not even considering all of this stuff. All we're saying is when a stock is at half book value, I want to look at it for the simple reason that if I believe this company will still exist, either I take the view that this company will not shut down. But if I think it will exist, which is A, it doesn't have so much debt on its balance sheet that it will sink. B, it has a half decent management who's demonstrated ability to perform in the past and it has some credibility and integrity in it. Then I'm willing to take a chance at half book value. And there is no fundamental reason. If you ask me explain why, I can't explain why. And typically you cannot ever explain bottoms or tops very well. Nor can even, not one company I can assure you told us at the peak of 2007 that 6 months from now my earnings are going to fall. Just like today, no one's telling us 6 months from now my earnings are going to rise, right? So you have to just go with a price, and something that has worked for many, many years will continue to work. So that is the pure and simple logic we are working with. So we are looking at companies where the current ROE is way below what it used to be. So we're looking at a 10-year history. We're seeing what sort of ROEs did this company do when things were a little better. What is it now? Is this business capable of coming back to a certain ROE whenever it does? And even if it does in the next 5 years, the price appreciation could be such that I'll cover up for my entire time frame of holding, even if it happens in the 4th year from now. So that's the way we are looking at companies. If I tell you names, by the time I walk out, I'll get fired, because as a compliance and SEBI rule, we're not allowed to take names. But the only thing I'll say is we're looking at half book value companies with all the qualifications that I spoke about. If you can manage to tick management, you can manage to tick the basic business economics, having been there in the past. And what we're removing from this list is we just do a 10-year history of shareholder value creation, which means whether has the stock price and has the book value grown more than what the market has delivered or less. Anybody who is less, we just drop out of our list. If you've not done it for 10 years, chances are you're not going to do it ever. So the first criteria is who has created value, and then within that is somebody sitting in a situation where today things are a little bad for them, stock is cheap, maybe we can use that opportunity. It doesn't throw up like hundreds of names, but whatever it throws up is interesting.
Yeah. We just had one last question, that was the request.
You told us about criteria for buying. Are there any criteria for selling growth stocks, especially? Like if you identified a stock, it has performed well, you are happy, but then should you sell first of all, and if you sell, what should be the criteria?
Yeah. No, it's again a classic question. So I'll convert that into an example itself. So let's say we go back to 2000 and we're sitting with Infosys as our growth stock, and the stock is trading at 100p, and some smart financial analyst is on TV saying 100p is justified because ROEs are 40% and it's growing at 40%. So don't worry, it's actually not 100p, it's only 30p 3 years from now. What do you do? And then suddenly everything collapses like a pack of cards. The stock falls to half its value. Interestingly, from the peak of 2000 to now, Infosys has still created some value. It's still compounded at 15%. Even after all of that sort of going down, not performing for 3 years, coming back, having management issues, the last 2 years has been very difficult for them. Yet you put it all together and it's a 15% compound. So the fact is we can't time these perfectly. Much as I'd love to say that, you sell it when it's 100p and then you'll remember to buy it when it's 30p, it never happens. So one option is just sit through it. Because if I rewind even further back, I'll give you this actual live, I mean, this is a true story. There's a gentleman, I won't take his name, but I know this person. He used to be an export of some goods. And he was also a small part-time investor. And he was very close to Enam Group. And Enam had done the IPO of Infosys way back in 1992-93. And he just happened to be sitting in Enam's office on the last day of the IPO. And Infosys' IPO was struggling to raise money. So the person in Enam asked him, he requested him, sir, if you have some money in the bank, aap dal do. And he was anyway a rich individual. In those days also, he had whatever, some income lying around. So I think he invested 1 lakh or 2 lakhs into it. The stock listed. A lot of people sold at various points in time. This gentleman just sat with it. He did nothing. That portfolio today, that investment of a few lakhs, I forget the exact number, but it was in a few lakhs. That is worth 250 crores today. Right? Now, he's seen 2000. He must have, for the next 3 years, been kicking himself that, this is how much I was worth and now it's come down. But he just sat with it and it's still worth a lot. So the point is, you will sit through cycles. You will have periods where you feel, this wasn't a great company to own. It's not done much. There's so many other companies who've performed. But then these things have a habit of coming back at various points. And over that time frame, it will meet your investment objective at least. So if you do that work up front, you could sit through the worst times of a company and still come out okay.
Thank you so much, Anup. Ladies and gentlemen, can we have a huge round of applause for Anup? I think it was a very enlightening session. I'm sure today your concept of bonds versus equity would have got clarified quite a bit. May I now request Mukul to please hand over a token of appreciation on behalf of Team Azure to Anup Maheshwari. Thank you so much, Anup.